Okay, so let's talk about stagflation. We hear this term thrown around, especially when the economic outlook seems a bit, shaky. But what does it actually mean? Like, really mean? At its core, stagflation is this, well, unusual situation where you have significant inflation, meaning prices for, well, pretty much everything are going up quite a bit, happening at the same time as high unemployment. And on top of that, the economy is either barely growing or, in some instances, even shrinking. It's like this weird mix, where things are supposed to be moving, but they're actually kind of stuck. And that's basically where the name comes from. Stagnation plus inflation equals stagflation. Now, what's really interesting is that stagflation became a major headache for many of the world's biggest economies back in the 1970s and 1980s. And it really caught a lot of economists off guard. The economic theories that were popular back then, like Keynesian economics and the Phillips curve, well, they didn't predict this could happen. They thought you couldn't have both high inflation and high unemployment at the same time. The Phillips curve, for example, suggested that there was this kind of trade-off. If you had low unemployment, you'd have to accept higher inflation, and vice versa. But stagflation, well, it couldn't blew that idea out of the water, showing that both could actually go up together. So our goal today is to dig into this whole stagflation thing. We'll define it clearly, look at the different theories about why it happens, and explore what it means for all of us. If you're finding this intriguing already, hit that like button and subscribe. It really helps us out. All right, let's get down to the nitty-gritty. Stagflation, as we said, is this tricky combo of significant inflation, meaning prices are rising, a lot high unemployment, and very slow or even no economic growth. It's this three-headed monster that makes it a real tough situation for anyone trying to manage the economy. And remember, stagflation wasn't just some theoretical concept. It really happened, impacting lots of major economies in the 70s and 80s. This period totally challenged the economists thought about things, especially those who followed Keynesian macroeconomic theory. That theory was all about managing the overall demand in the economy. The idea was that governments could smooth out the ups and downs by adjusting their spending and taxes. But stagflation, with its simultaneous high inflation, high unemployment, well, it didn't fit into that framework. And as we mentioned, it messed with the Phillips curves idea, the simple trade-off between inflation and unemployment. Stagflation basically revealed a big gap in how people understood the economy. So what could possibly cause this stagflation now? Well, economists have been debating this quite a bit, especially after the 1970s turned everything upside down. One major explanation is the idea of a supply shock. Imagine if something happens that suddenly makes a vital resource or service much harder to get. What do you think happens to the price? It skyrockets, right? And when prices shoot up like that, it puts a real squeeze on businesses' profit. They can't make as much money, so they might slow down their production, and that can eventually drag down the whole economy. Another big idea is that bad monetary policies can create the perfect storm for stagflation. The argument here is that central banks and governments can make mistakes when they try to steer the economy, and these mistakes can accidentally set the stage for stagflation. For instance, before the 1970s, the US government was really focused on achieving maximum employment. They even made it official with the 1946 Employment Act. Now, some economists argue that this laser focus on jobs actually ended up fueling inflation, which then backfired and hurt both employment and economic growth. Another example is President Nixon's approach, which involved devaluing the US dollar and putting limits on wages and prices. It was called the Nixon shock, and it shows how government policies can have really big and complicated impacts on the economy. This whole thing highlights the tricky balancing act that central banks and policymakers face when they're trying to keep prices stable, keep unemployment low, and keep the economy growing. It's especially hard when you're dealing with something as messy as stagflation. Actually, many economists believe that the way the Federal Reserve managed the money supply was a major player in the stagflation crisis of the 1970s. So we've got these big picture ideas, but there are also some more specific theories out there. One of them is called differential accumulation, and it's been put forward by economists Jonathan Nitzan and Shimshon Bishler. Their theory connects mergers and acquisitions, stagflation, and globalization. They say that companies are always trying to get more capital than their rivals. This leads to more mergers and acquisitions, which puts more power in the hands of fewer, bigger corporations. And what happens when a few big players control a lot of, say, the oil supply? They can limit production if it benefits them, even if overall demand is high. And guess what? That can push prices up, contributing to that stagflation squeeze. Then there's the demand pull theory of stagflation, developed by economist Eduardo Loyo. The theory suggests that stagflation can actually be caused solely by decisions about monetary policy. You don't even need a problem on the supply side. Governments can create stagflation by tightening the money supply, like raising interest rates or reducing the amount of money circulating in the economy. If like slamming on the brakes while the car is still going fast, you might stop the car, but you could also stall the engine. On the flip side, we've got the cost push theory, which focuses on how inflation that starts on the supply side can be a main driver of stagflation. In this case, businesses are facing rising costs for things like raw materials or energy. This cuts into their profits, so they might reduce production, and that can lead to more people losing their jobs. Things like tariffs, bid wage increases that aren't matched by higher productivity, or shortages of workers in key industries can all contribute to this kind of cost push inflation. And we can't forget about the historical context of the end of the gold standard. Some theories suggest that President Nixon's decision to unlink the US dollar from gold, which basically ended the Bretton Woods system, played a significant role in the stagflation of the 1970s. The idea is that when the dollar was no longer tied to gold, its value went down, and that had a big impact on both inflation and economic growth, contributing to a stagflationary mess. As you can see, there's no single universally accepted answer to why stagflation happens. It's a complicated economic puzzle with lots of potential pieces, and economists are still debating and analyzing it. So we've talked about what stagflation is and some of the possible causes, but what about the consequences? How does this mix of economic problems affect people, investors, and global trade? For individuals, stagflation can be a really tough time. It reduces their purchasing power, making it harder to afford even basic things, especially for those who lose their jobs. Even if you keep your job, there's the worry that you might lose it, and wages might not be growing much or at all. This can make people lose confidence in the economy and spend less, which just makes the situation worse. Investors also feel the pain of stagflation. Companies often feel their profits shrink because their costs are going up while sales are going down, and this usually has a negative impact on the stock market. Historical data shows that during stagflation, stock market returns have often been negative, which is a big contrast to the average returns you see in more normal economic times. Stagflation can directly hurt investors by slowing down the growth of companies' earnings per share, which is a key factor in how stock prices move. If you rely on dividends for income, you might see companies cutting back or even stopping their dividend payments to save money. And if you're invested in growth stocks, companies that are expected to grow really fast, you could lose a lot of money if that growth doesn't materialize because of the stagflationary environment. In severe cases, companies might even go bankrupt, which means big losses for investors. And when there's a higher risk of companies defaulting on their debts, that can also hurt bond prices. However, there are some strategies investors use to try to protect themselves during these times, like investing in funds that are designed to do well when inflation is high, or they might focus on investing in well-established, financially solid companies in industries that are more likely to weather the storm or bounce back quickly. So stagflation affects individuals and investors, but it also has consequences for international trade. It can drive up the prices of commodities globally, including essential things like food. This makes it more expensive for businesses all over the world and can fuel inflation even further. If lots of countries are struggling with high unemployment, it can reduce global economic output, weaken consumer confidence worldwide, and lead to even less spending internationally. This can create a vicious cycle, with unemployment spreading because of the interconnectedness of global trade. And if different countries try to fight stagflation with conflicting policies, it can create even more disruptions in the flow of goods and services across borders. This can be especially tough on emerging and developing economies, which might not have the same tools as richer countries to stimulate their economies because they have high levels of debt. To really understand how stagflation can play out in the real world, it's helpful to look back at the 1970s. The oil crisis of that decade is probably the most famous example of stagflation in action. In 1973, OPEC, the Organization of the Petroleum Exporting Countries, announced an oil embargo against the US and other countries that supported Israel during the Yom Kippur War. This embargo sent oil prices through the roof, more than tripling them in a very short time. This was a huge problem for the US, which was heavily reliant on cars, and the high oil prices stuck around even after the embargo officially ended. At the same time, manufacturing jobs were leaving the US for countries with lower labor costs, and the Vietnam War was putting a big strain on the economy. The result was a long period of stagflation, with high inflation driven by oil prices, rising unemployment, and an economy that was something neutral. The US economy was also shifting away from well-paying manufacturing jobs towards lower-paying service sector jobs. This meant that real wages weren't keeping up with inflation, so people had less money to spend, which further slowed down the economy. President Nixon tried to fight fight this stagflation by devaluing the dollar and putting limits on wages and prices, that looking back, most people see those actions as policy failures. Many economists now believe that the Federal Reserve's actions, particularly expanding the money supply, were a major contributor to the stagflation crisis of the 1970s. Back then, people generally thought that high inflation meant low unemployment, but the 1970s proved that both could actually rise together, which was a big surprise. This experience forced economists to rethink their approach, and they started focusing more on achieving both low unemployment and stable prices. It's worth noting, though, that not everyone agrees that the oil embargo and the resulting oil shortages would be only cause of the 1970s stagflation. Okay, so we know stagflation is bad news, but what can we do about it? Well, coming up with effective responses is really tricky for central banks and policymakers. That's because trying to fix one part of the problem can often make another part worse. For example, raising interest rates is a common way to try to tame inflation. It makes borrowing more expensive, which can reduce demand in the economy, but it can also slow down economic growth and potentially lead to more unemployment. There are a few different approaches people have proposed for dealing with stagflation. Monitors' responses focus on getting inflation under control, even if it means accepting higher employment and slower growth in the short term. The UK government in the early 1980s used this kind of strategy. They managed to bring inflation down, but they also triggered a pretty bad recession. Supply-side responses aimed to increase the overall supply of goods and services in the economy. This could involve policies like deregulation or temporarily getting rid of tariffs on imported goods. The idea here is to make it cheaper and easier for businesses to produce things, which could help with cost-push inflation. But these kinds of national policies often don't work very well when you're dealing with disruptions to global supply chains. Wage control responses might be considered if wages are rising too fast and squeezing companies' profits. In this case, putting limits on how quickly wages can increase might help to control inflation. Neoclassical responses are based on the ideas of economists like Friedrich Hayek. They argue that the best way to fight inflation is to stop using expansionary monetary policies and let prices adjust naturally through the free market. That means things like not increasing the money supply and not lowering interest rates. And believe it or not, some economists actually suggest just waiting it out. They think that stagflation might sometimes correct itself over time without any intervention, and that trying to force a solution could actually cause a recession. And as we mentioned before, investors who are worried about stagflation might use hedging strategies to protect their investments. This could involve adjusting their portfolios to include assets that tend to do well when inflation is high, or focusing on investing in stable, established companies. So after all this, it's clear that stagflation is a really complicated issue that economists are still trying to fully understand. There are lots of potential causes, and there's no one-size-fits-all solution for how to deal with it. It's a tough challenge for central banks and policymakers, and it's something we need to keep learning about and discussing. Well, we've covered a lot of ground today exploring all these different aspects of stagflation. If you found this discussion helpful and you want to hear more deep dives like this, please hit that like button and subscribe to our channel. Your support means a lot and helps us keep making this content. Thanks for listening.